Welcome to CEO Money. I'm Michael Yorba. Thanks for joining us. I have Bernard Reisz, ReSure Financial with me today. Bernard, welcome to the show.
Thank you, Michael. Great to be with you and the WFN1 audience.
Thanks. All right, give us some background. There are some new listeners, a lot of new listeners and viewers on the show since you were last here. Talk to our audience about you and then ReSure Financial, and then let's get into the real estate conversation we're going to have about your style of investing.
That's great. I love introducing these concepts. They're novel concepts. They're eye-openers. We introduce people to things that they never knew they could do before. I am a CPA, and as a CPA, we get to see lots of tax returns. And one of the things we encounter every year end when it comes time to file people's taxes, IRAs, 401k contributions to improve their tax returns, getting tax deductions. But that's only the first step in maximizing the value of retirement accounts and their tax advantages. And we'd find that people would put money into these accounts to optimize their tax return, but then they'd be at a loss as to what to actually do with those funds. Sometimes they would just sit in cash and they wouldn't be taking advantage of the tax-free compounding that they could get. And other times they would be making other suboptimal investments and not using them in the best way possible. So we got involved in self-directed and checkbook control retirement accounts that give folks the ability to take IRA money and 401k money and direct it to off-Wall Street investments. And for each person, it may be whatever appeals to them. Some want to put it into real estate, others into private equity, others into precious metals, some want to put it in cryptocurrency. It's about giving the investor the control and the ability to direct the investments to assets that they choose.
Got it. Now, you wanted to talk about real estate today.
Yes, real estate has always been the most popular way to utilize these accounts. Cryptocurrency gave it a big, at the end of 2017, beginning of 2018, cryptocurrency was really, really popular. We're moving back to real estate investing and real estate-based investments as being the most popular again. Real estate investing includes what you think about buying real estate equity investing, but it can also be real estate debt investing, a really, really excellent investment for checkbook IRAs and checkbook 401ks is private lending. Do you think we should introduce the audience to the concept of private lending?
Yes, absolutely. I'm sure a lot of the audience is familiar with it, but I'd like to hear what you've got to say about this.
So in a nutshell, private lending is taking the place of the bank. If you got investable funds and there's a real estate investor, somebody that's doing deals, perhaps doing fix and flips, or even buy and holds, and they need funds quickly to close a deal in a way that the bank won't give it to them, you can be the bank. You can lend in the money and collect interest payments just like the bank would, and you can secure that loan with the real estate, a hard asset, in the same way that a bank would when it issues a mortgage. The reason why I love these investments for retirement accounts is because they can be very, very lucrative, extremely profitable, showing returns between 10 and 20%. But there is no tax shield. On a tax return, that would show up as ordinary income taxed at your marginal income tax rate, which is whichever bracket you're in, or it can even push you into a higher bracket. It doesn't benefit for any tax shield. So if you do those inside of a retirement account, be it a solo 401k or checkbook IRA, you get those 10 to 20% ROI completely tax-free, and you can keep reinvesting those profits. So you keep that much more of your money, and you keep that much more compounding tax-free for decades, potentially.
Got it. I could see that. I assume that they're very popular with the people you're working with.
Oh, yes, these are, and we encourage folks to pursue the avenue of real estate investing that appeals to them. And it's different for some folks who want to do tax liens and tax deeds. Some want to do mortgage notes, buy either performing or non-performing mortgage notes. Some are doing commercial real estate, others do multifamily, others do single family. there's just so much opportunity and so many different angles. And I'd say one way to classify it is we have those investors that are experienced, and they've learned that they can do so much more with their money in real estate than they can do in the stock market. So rather than give it to a financial advisor or a stockbroker that's going to take a commission, they're going to direct their retirement accounts into real estate. Another category that we deal with are newbie investors, folks that don't have that much experience in real estate, but they see the potential that it presents above and beyond what they can get riding the waves and volatility of the stock market, and they want to get in on it. So they've got capital locked up in their retirement accounts, and that's their way to get in. They may begin as a private lender. These are ways to get visibility into real estate and get involved in the space.
Got it. The downsides, because there's a downside on everything. How do you make sure that the clients don't get into a bad loan, don't make a bad loan? What are you doing there?
So we definitely educate the clients. The loan, the primary thing here is everybody's got to have their choice. And within loan strategies, everybody's got to develop their own strategy, but we do educate them. As a matter of fact, I just got off the phone with a client that was looking to do private lending, and I outlined some strategies that I've used in my private lending. The key things people have to be aware of is the value of the collateral, which is you don't want to foreclose on the house that you're lending against, but you've got to protect yourself. So you've got to have some sort of concept of the value of that collateral, either through a full-blown appraisal or perhaps a broker's opinion, a BPO, or through comps, depends on your level of sophistication, the size of the loan, and you're going to calculate your loan to value against how much that value are willing to lend. And then there's a concept of ARV, the after repair value, which comes in a fix and flip. So in a fix and flip, the real estate investment sponsor is going to be buying a property, say for $100,000, and they're going to be improving that property, putting in another $100,000, and they'll be all in at $200,000, and the expected value of that property, of that asset after the rehab, may be $300,000. Well, when you initially lay out those funds, you don't want to be lending against that 300 because that value's not there. So one of the strategies we advocate for is dispersing the funds incrementally. So in a rehab, there are different stages of work. So if they're doing the HVAC, okay, advance money to get that done. Once the HVAC is done, and they prove that by your receipts or whatever you're doing to track it, then you can advance funds for the roofing. Do it incrementally so that you're never exposed to an extent that exceeds the value of the collateral.
I get it. That's brilliant. Is there anything else that you want to talk about the real estate private equity lending that you're seeing out there that may be new to some other people that you want to bring out?
There's always variation in the space. What I would say to people, and anybody that gets involved in this, and we can't have this conversation without mentioning it, there are compliance matters that you have to be aware of when doing this. So one of the things that you may not do with your IRA and 401k is self-dealing. And that means your IRA and 401k can do real estate, can do private lending, can do tax liens, but you cannot lend money to yourself, nor should you be lending money to a parent, a child. So there are certain related parties that you should not be doing business with. And for people getting involved in this space, sometimes those are the low-hanging fruit. Their way in is to deal with a family member, and they've got to know who is, within the rules, within the IRS guidelines that they can lend to, and who's out of bounds. So it's those lineal descendants and antecedents. So parents, grandparents are off limits, children, grandchildren are off limits, but brothers and sisters, aunts and uncles, in-laws, you can do business with all those. Your best friend, so that's all fair game. And if you're aware of that, it's a great way to maximize the value and the tax advantages of these accounts.
Great. Bernard, it's been a pleasure. Next time you come on the show, let's talk about private equity and more crypto lending and the other alternative methods to enhance the return in your retirement accounts. Does that sound good?
That sounds great, Michael. I love being here. I love being on the show with you, and I look forward to doing it again.
Thank you. All right, you've been watching CEO Money with Michael Yorba. Don't forget, like us on Facebook, follow us on Twitter, and subscribe to our YouTube channel. We'll be back with more great content just for you.